Welcome back. Week 5, we're up to now. Going to be discussing investing today. So, quick summary of the last few weeks. Week 1, we spoke about money story and money mindset. Week 2 was all about goal setting. Week 3 was looking at your budget. And week 4 was talking about home loans and how to repay your home loan. So this week, a bit more exciting, we start talking about investing and looking at the 3 principles that need to be understood about investing, how investing ties back into your goals, looking at your risk and the time frame of your investment, and then the risk to return reward as well. Get some expert advice as well, and then we'll sum it all up at the end and answer any questions you may have. So the number 1 principle to investing that all my clients I take through this process is compound interest. So this refers to increasing the value of an asset due to the interest earned on both the principal and the accumulated interest. So it works for both assets and liabilities. So this is how we see banks, particularly through their credit cards and personal loans for cars and things like that, they make a lot of money. Because if you miss a repayment, it starts to accumulate and snowball and have that snowball effect. Whereas the same thing works with investing as well. So as we see here, this is called simple interest. So if you were to invest $10,000, the interest you earn would be $500 each year. So after 5 years, you've got a total of $2,500 interest earned on your $10,000 investment. So a total of $12,500. So what does this look like for compound interest though? So compound interest, we're looking at each year, as you see, it's not just the $500, but then we start reinvesting that. So in year 2, it's $10,512. So the interest is a little bit more. And then in year 3, it's $11,000 we've invested. So it's $565,000 of interest. And it starts to snowball. So in year 5, we're actually earning $625 of interest. So after the 5 years, we've got $12,800 instead of $12,500. So using this example may not seem like a lot, but the same effect happens with our superannuation when we've got $100,000 in there or $200,000 in there. Then this little bit of difference actually starts to make sense. So this is compound interest. This is why people invest. Compound their money and grow their money. Any questions about compound interest and what that means? No, we're all good? Perfect. So the second principle I like to tell all our clients about is educate them about dollar cost averaging. So we hear a lot of clients come in and especially see it on YouTube and the internet these days. When's the right time to buy a stock? When's the right time to invest my money? I've got this money. Should I invest today? Should I invest tomorrow? Should I wait? So markets go up and down. It's completely normal and it's known as market volatility. So no one's got a crystal ball and no one knows what the market's going to do. So this process involves investing small amounts regularly. Even if the market's falling, it can help you ride out these downturns. So this is known as dollar cost averaging. As we can see here, we buy on the low, we buy on the high, we're buying on the way down. So every month we're buying, regardless of where the stock price is. And then dips down here and we're buying again in month 8. And it comes back up, we're still buying. Every month we're buying the same amount. So we call this dollar cost averaging. So the average price is straight through the middle. Straight through the middle there. It's not down here trying to pick the low, or not up here where you've picked the high. It's every month regardless of where the investment is, and the average price sits smack in the middle. So how does this work? So explaining just what I went through. So if you were to invest $1,000, instead of investing it as a lump sum today, you invest it in small amounts. So $100 each month for the next 10 months. So regardless of where the share price is or the market moves or whatnot, we're investing the same amount every month. So for example, stock of choice was priced at $10 in the first month. You would purchase 10 units for your $100. But then if it dipped down to $5, you can purchase 20 units and so on. In the end, you would have purchased more shares when the prices were lower and fewer when the prices are higher. So the outcome may have invested more prudently than simply investing a big lump sum at the start, where you could have been investing right here at the top just before it fell, or right here at the bottom just before it rose. So let's look at another example. So let's say we had $6,000 to invest. You can choose to invest all at once or invest regularly every month for 6 months. Okay, so in this example, you invest on day one, you get 600 shares, okay, at $10 each. However, if we're investing every month for 6 months, the first month, we're investing 100 shares at that $10 mark, but then we're going 77 shares because the share price has gone up a little bit. But then when it drops, we get to invest more and purchase more shares and so forth and so forth. So in the end, you actually buy 600 shares at the start using a lump sum of $6,000. Or if you invested each month with this volatility that happened, you actually bought 78 more shares at a lower price. So you're actually making more money on this particular investment. So that's the whole concept behind dollar cost averaging. And this is what we recommend for all our clients as well. So this is what you do with superannuation. So you'll get to see your employer, they make a contribution each month or each quarter, and they automatically buy investments in your super, regardless of where the market is, whether the market's down here or the market's up here, your super fund buys investments for you. So they're dollar cost averaging. You're already dollar cost averaging through your super without even knowing. But looking at doing it personally, this is what many of our clients do as well. Reduces the risk as well, and have to guess the timing of the market, saying, are we at the top? Are we at the bottom? I'm not too sure. Let's go every month and invest anyway. Any questions from that side of things? No? We're all good? Okay. The other big principle when it comes to investing is, everyone would have heard this, don't put all your eggs in one basket. What does it mean? Don't have all your money in one place, as you could lose it all in one go. So you hear lots of people at the moment investing in or gambling in cryptocurrency. Don't have all your money in cryptocurrency. Don't have all your money in a stock, whether it's BHP or a bank or anything like that, because you could lose it all. So the other factor to consider when it comes to investing is your investment time frame. So people have different goals, which we discussed in week 2, which really comes back to your investment time frame. Some people might be looking to buy a house, other people might be looking to retire. So everyone's got these different goals, which come back to different time frames. So based on your time frame, you may be willing to take more risk or less risk with your investments. So that dictates what type of assets we look at, whether there's property, cash, shares, cryptocurrency even. So for example, some investments are high risk if you're looking to invest for the short term. So if you invested in a property for 6 to 12 months, the transaction costs would kill you. So the stamp duty, the legal fees, the agent's commission, all that type of thing that comes in with a property that may not be the best opportunity for you to invest. So looking at your investment time frame and your tolerance towards risk. So some people have different tolerances towards risk. Generally, males are risk takers and females tend to be a bit more conservative and want security and preservation of their money or their capital. So just taking both those into account. And when you're in a relationship, it is about taking both those into account and looking at the risk return and the trade-off and what really works for you guys and the goals that you have. So some may not be happy at the moment getting a 0.2% interest on what they've got in the bank. However, the government has guaranteed this money, so it's considered safe with the guarantee. Whereas investing in property and shares may offer potentially better returns, but these investments are not without their risks. So it's about getting that fine line between, well, what's going to work for us, what's going to get us to our goal closer, rather than what's going to make us the most money, what's going to take the shortest amount of time, let's take the most risks. So we kind of reverse engineer what investments we're looking for. So this is a good mix of what we look for when we speak to clients. So you see the left-hand side around here, cash is down the lower end. So lower returns, but also lower risk. As we go up the spectrum, we see term deposits, fixed interest, which is bonds, potentially higher returns, but they're starting to get a little bit more risky. So we're seeing at the moment, the value of bonds are getting smashed. So it's actually called fixed interest, but they're actually losing money, which is crazy. Some people don't understand that side of things. And we go further up the spectrum, property, we start to earn more money, but we're taking more risk. And then shares, we're taking more risks again, but we're expecting higher returns again. And then we've got alternative investments like gold, cryptocurrency, other commodities as well. And they're again risky, but we're expecting those higher returns because of the risk we're taking. So this all ties back into what we're speaking about, putting eggs in different baskets or diversification. So when we're looking at investing, fear of losing money is one of the reasons that a lot of people get wary about investing. So putting money in different investments, or as I like to call them, different buckets, this can help reduce the risks. So in technical terms, it's called diversification. So spreading your risk, spreading your money into different investments, such as shares, bonds, cash, property, so a bit everywhere. Why should I split my money across different baskets? Let's say you choose to have some money in cash savings account, so that's easily accessible. You also got your own home, so you're in the property market. So you've invested there. And you've got superannuation, which is a mix of shares, bonds, property, and cash. So at the moment, if you look at your personal situation, you're in all these different asset classes and you are diversified, as not all asset classes are affected in the same way by different economic events. When one investment basket doesn't perform so well, another may outperform, which provides some protection against major losses as well. Can't see that, can we? So this is really just explaining the different asset classes. So at the top, we've got Australian shares, international shares hedged, which means against the currency. So if the Australian dollar falls or rises, that's taken out of the equation. We've got US shares by themselves, Australian bonds, international bonds, cash, listed property, and international listed property. So the red mark here highlights every year which asset class was the best performing. So if we scroll down to 2020, the best performing was US shares, at 9.8%, whereas at cash, we're getting 0.8%. Crazy, crazy. But if you look the year before, cash, we're getting 2%. We're getting 16% in US shares, but Australian listed property was 19%. So you see, every year it's almost a different winner. So having that diversification kind of offsets some of these losers that we may get. Like last year, Australian listed property experienced a 20% fall. So a fifth of your money invested in Australian property disappeared. So this isn't residential property. This is your Westfields, your big CBD office blocks and things like that. So due to COVID, lots of people weren't paying rent. So they experienced a fall in value. So that's why they got wiped out last year. So any questions about that side of things? No, all good, perfect. So this is a little snapshot of what we talk through with our clients as well. Normally we do the research on their behalf, but before investing $1, so you work really hard for your money. Don't go gambling it or investing it without doing your own research. So they normally say before you invest $1, do 100 hours of research in a business or a stock or a managed fund or something of that nature. That includes looking at YouTube, looking at their financials, understanding their business, attending one of their AGM meetings, seeing a podcast from one of their CEOs or CFOs. Also, when looking at businesses, look at those businesses that have a monopoly in a particular industry. So, for example, you've got the big banks, the 4 big banks, they have a monopoly in the financial industry. Your Woolworths and Coles, your supermarket chains, they have a monopoly. Your Bunnings has a monopoly. All these types of businesses have a monopoly in their particular industry. So what that means is they can pick and choose and gouge their consumers as such, because they are the biggest and they control the market. They control the cost. The other important thing is the breadth of experience across the board. So having key people on the board. Generally, you have someone that's really experienced from the legal sector, someone that knows the numbers, accounting side of things, and then you have someone from that industry, whether it's someone that's come from Woolworths as well. They've got that background. They've been in the business for 20 years, or they've been on other boards in America from Walmart or things like that. So having that experience on the board really helps and guides the direction of the business as well. And then looking at the past performance of key management figures like the CEO and the CFO. So find out where they were before, how that business went before when they were working there, what happened, why it didn't work, how they're performing in their current role. Are they meeting their KPIs? Are they outperforming stockbrokers analysis, things like that. And then we dive into the numbers side of things, which can get difficult if you've never looked at financials of a business before. But there's some really cool YouTube clips out there, and also I can help talk you through the key indicators that you look for, just making sure the financials of the business are safe and sound, and heading in the right direction. Because before you put money into something, you want to know that the business is going well and they're not going to take your money and disappear. Did we have any questions, guys? Owen, Gary? No. All good? Yeah, perfect. So yeah, when looking at your investments, make sure you always review and track your investments as well. So a lot of investments aren't set and forget. Need to stay on top, continue looking at the financials, looking at the research, doing your own research to make sure your money's still secure and still helping you towards your goals that you're looking for. So that was pretty short without too many questions from you guys. So we did have an expert that I'm interviewing tomorrow. He couldn't come on live because he's on his way back from Perth. So he was actually over in Perth, seeing different businesses and doing exactly what I just said, doing their research. So he looks up after over $1 billion. And I'm going to get him on and talk about what they look for when they invest in companies, what to look for you guys as well. Did you guys have any questions that I can ask him on your behalf or anything like that? Maybe get some share tips from him as well that may help. No. Hold on, I'll unmute. How do we unmute you guys? I'll start unmute. There we go.
Yeah, we we're just going to say, what's that one you're talking about?
ETFs.
Any much downs or thoughts on ETFs?
ETFs?
Yeah.
ETFs are great because we jump back. So there's different types of ETFs. So we can have an ETF in particular shares. So like Australian shares that just cover the top 200, or we can have an ETF that covers all these investments. So they have cash, fixed interest, property, and shares. Or we can have ETFs just in Asia, just in gold. So yeah, effectively they're what we call exchange traded funds. So someone sits there and is a fund manager and says, well, we're going to invest in the top 200 Australian shares. So you can invest $100 and get access to all top 200 shares.
Yeah.
So it's a really effective way to, when we're talking about don't put all your eggs in one basket. If you've only got $1,000 or something like that, it's a really good way to diversify really quickly. And then once you have that diversification, then you can start picking and choosing individual shares. So you've got the foundation right there. Does that make sense?
Yeah.
Yeah. Do you like these apps and that, like Raise and Spaceship? Have you heard about them?
Yeah, I've heard about them. I probably prefer Raise.
Yeah.
Is my preference. I've used it personally.
Yeah, I use both. I've got Dad's on one, and I'm using both of them just as like a little.
Yeah,
you know.
I read the PDS, which if you've got a spare hour to fall asleep, I read the PDS of Spaceship one, and I just couldn't get behind the fees that they hired there and things like that.
Yeah.
It is very niche in what they're investing in, which is tech and all that type of stuff, which is brilliant at the moment, what everyone wants to invest in, which is great. But yeah, I just prefer a bit more depth to it rather than just what's hot at the moment type of thing.
Yeah, because Raise has got that custom portfolio on that now.
Correct, which is pretty cool. It's pretty cool. So yeah, it's just allowing you to do that much more with what you've got as well.
Yeah, and it's handy with the roundups and that. Just takes the money out for you, rounds up the little small things you buy.
Correct, and you don't even miss it.
No.
That extra 50 cents or $1 or $2 here and there.
Yeah.
Great way to start. Great way to get your knowledge behind it, especially small amounts as well. So you get a better understanding. You've got live money in there, so you're more interested in what's actually happening rather than
what they're doing with your money.
Correct, rather than just doing research without your money on the line. I always find you tend to learn quicker when your money's involved. So yeah, great way to get started. Are there cheaper ways to do it? Probably, yes. Does that matter at the moment? Probably not at the stage you're at. It's all about just getting that as much knowledge as you can. So as the money continues to flow in from work, then you know where to put it. So yeah, apps are good. They automate it, which is good as well, because it takes you out from saying, "Oh, I've got $500 in my account. I can buy a new set of tires, or I can buy this investment."
Yeah.
We may get the tires to go drifting instead. So
Yeah.
So-
Depends on the weekend.
yeah, it depends on the weekend, right? So yeah, just having that automation kind of stops that, question. You never have that question then.
Well,
you're
maybe
putting,
he just needs to invest in a tyre manufacturer in his shares, mate, and you won't have to worry.
possibly, it sounds like it. So yeah, ETFs are great. Those apps are great. Index funds, which is very similar to ETFs, they're great as well. They give you that diversification, and then as your portfolio starts to grow, then start adding what I call sexier investments, like individual shares or individual managed funds. Like the expert we're interviewing tomorrow, Jeff. So he's from Ophir Asset Management. And their performance has been 30% year on year for the last 5 years, which is crazy.
Yeah, that's pretty good.
Crazy. So with over $1 billion invested, tends to get harder to move money then. So it's not with $1,000. It's with over $1 billion they're getting these types of returns. And so that's the cool stuff that you start to add to your portfolio after you set the foundation with the ETFs and things like that.
Yeah, sweet.
Does that make sense?
Yeah, no, I think that's good.
Any other investing questions, guys? Particular stocks or anything you've heard?
Yeah, righto. May as well while I'm on the bandwagon. I've been watching Zip lately, and it's pretty low at the minute. So is Afterpay, but Afterpay are a bit expensive for my type of shares.
Yep.
Zip's down at like $8.50 today, and I was looking at investing 500 in it pretty soon. What's your thoughts on it?
So I'll ask the question tomorrow to the expert because I've spoken to him about this at length. So there's 4 or 5 different players in this market, in this Afterpay market. You've got Zip, you've got Afterpay, you've got a thing called AIM in the US that came up in the last 6 weeks. And then we've got one that Combank owns 50% of. Starts with KLU, Kaluna or something. Combank has that and are offering it to their
I've been watching the stocks on Comsec, so
so at the moment I still lean towards Afterpay just because of how much market share they have, how much exposure they've got overseas as well.
I'm just thinking, like, buying 50 shares compared to 5, you reckon the 5 would still be better off?
So if your 5 shares make, I always go back to percentages. So if your 5 shares make 50%, but your 100 shares make 5%, which one do you want to be in? One that makes you 50% more money, or one that makes you 5% more money?
50% all day.
Yeah. So I try and take out whatever dollar amount the stock price is, and just look at the types of returns, the types of business, everything we went through on this page. So who's got bigger market share at the moment?
Actually, it'd be interesting to hear what he says about the whole thing with COVID, whether Pfizer or AstraZeneca is worth investing in at the minute.
Yeah, so a lot of those guys, well, because I know the industry pretty well, especially over in America with my sister over there. And a lot of those guys had to provide a lot of those vaccines at cheaper rates for government and things like that due to being a pandemic. So, it's just working out how much does that actually benefit their bottom line as well. So yeah, I'll ask him that question. I'll ask him both the questions about the Afterpay market, and also the pharmaceutical market, especially in
And
America.
one last one to hit you with.
Far away.
Super. So I mentioned it to you briefly. Is there any benefit in doing like an extra lump sum member voluntary contribution from a tax side of things, or you're better off?
Hold on
just
one second with that question. I'll